Welcome to tonight's webinar. We're very excited for this one. I personally love working with Mike and Mike Coval. Tonight's webinar topic is market strategies for investors and for the savvy investor, and that is so true. Especially with what Mike Coval and his team teach. I honestly, I know I'm biased, but I gotta say it really is a pretty amazing thing. I'll get on a little intro in just a second, but you might have heard Mike and I talking in less than 48 hours. Mike and myself are going on this high yield investor cruise to Alaska. So I usually bring the kids with me. This time the kids are staying home, so I'm super excited. My wife's coming with. It should be a great trip. We've got some great presenters there. Sorry, guys, the ship is full. So that is no longer available, but we'll let you know when the next one comes around. Also wanted to mention briefly here the Millionaire Conference. Now, this is going to be in Dallas, August 20th. From 1 to 6. This is going to be kind of fun. Mike will also be here. I was just telling Mike, we're going to spend a lot of time together, Mike. I like this. This is good for me. So anyway, thanks
Well,
for coming to
it's
this
easy
one.
for me. Yeah, I like to talk about the stock market, so it's always good for me.
Well, then win-win. All right. I like to learn. So this is good. This is honestly really, really neat. So if you can make it, if you're in the area, it's kind of a new thing we're doing. And we actually are very, very excited. George Wright, if you know George, he's worked with us for a couple of years. Noah St. John, you probably heard it, author of several books, incredible guy. Chad McCall, real estate. Alex Morton on some crypto investments. And clearly Mike, awesome. And on options trading and really the market in general. And then Brandon Boyd, he's a terrific motivator. So this would be a fun conference, very well rounded, just something different for people in the area. If you're there, love to have you. You can register at themillionaireconference.com. Also, upcoming events that we have, our 3-day asset protection summit will follow that. Dallas, September 12th through 14th. It's a Thursday, Friday, Saturday. Really want to make sure and emphasize this for everybody. The room block is $119 per night. And it expires August 27th. So they guarantee us rooms, but they're telling us it's going to be pretty full. So sometimes if they're full, they're full, and there's not a lot we can do. And really, truly, I'm not just saying this for urgency, but the 119 rate is a tremendous deal from what you can actually get if you go on the website right now at the hotel there. So it is a great deal, and it will fill up. So if you're looking to come to Dallas, do it quick because it will be full. Also, Las Vegas, November 11th through 13th. If you haven't been to our summit yet, it's a tremendous opportunity. It's 3 days. We like the slogan, a lifetime to accumulate assets, right? A lifetime to build wealth, but only 3 days to protect. Even if you have a team of attorneys or people you work with, estate planners, advisors, we strongly suggest you come because you need to be involved in the process. The process of protecting your assets, reducing taxes. We know one of the greatest indicators of wealth in the country. Studies show that you spend more time learning about your estate and reducing taxes. Everyone can invest, but spending more time on reducing taxes and protecting your assets and investing, that's why we have Mike here tonight, is really where it's at. So that creates more wealth than anything else. You can register at protectwealth.com. We do have VIP registration discount available for $99 per person. That is available at protectwealth.com/VIP. Love to have you there. We always do a disclaimer. We're an asset protection company. This is not legal or financial or investment advice. We always encourage you to seek out competent professionals for that, for you specifically. And we're really, really, truly excited to have Mike on the call tonight. Mike, I actually have seen Mike for a couple of days, give some training with him and his team. So I've actually been through some educational classes, and this is my experience. I actually spent several years with several different companies learning, futures, currency, option trading, things that everyone said is so risky. And frankly, you know what? I learned a lot. I learned all the straddles, strangles, butterflies, whatever. I know, Mike, you know all those details in and out because that's what you love. But I tried to learn it. Honestly, it was super overwhelming for me. And I made some money and lost a lot of money. It really went nowhere for me, but I knew a lot about the market. And that just didn't do a lot for me. I'm truly honestly saying this, Mike, when I actually learned your program, options trading that everybody said was so risky, then became so simple. And I'm not kidding, it really is. With my experience, it is probably by far one of the most simple strategies I've ever learned. And it really is, it doesn't take a lot of time once you get used to it. So there's no better guy, in my opinion, to learn than from Mike Coval. So many years of experience. Mike, I'm going to turn it over to you. And maybe you want to
Okay.
tell them a little bit about how you guys started, for those of you guys who don't know. But yeah, you guys are in great hands. And Mike, I'll mute myself. And if you want to answer questions, you can ask them. We can leave those to the end as well.
Okay, sounds great. Everybody, I think we just switched screens. Please let me know. I've got two monitors up here, so let me know which screen do you see. Do you see the PowerPoint
Stock
presentation?
market training. Yep, looks good.
Perfect. That's what I wanted to make sure. Okay, great. All
Thanks,
right,
Mike.
everybody, thank you. My name is Mike Coval. I see some of the names already logged onto the webinar here, and I recognize a few of those already, so some of you are familiar with me. Excuse me, I'm just getting over a cold. Great to have you back, for those of you who have been with me before, and for those of you who don't know me, I am an active investor, stocks, options, bonds, futures, commodities, currencies. I like to trade a little bit of everything. I also speak very fast, so you'll get a little bit more than an hour's worth of a presentation tonight in the hour, but I think you'll have a good time. Now tonight, as I go through this, I want to talk a little bit more about not just trading, which is really what I like to do. Trading is more of an options, futures, currency type of thing. Tonight I'm going to talk more about investing and taking the market as a whole. And that's where I want to go with tonight. And at the end of it, once I finish, I'll be happy to answer any questions that you might have. Well, thanks, Jim. That was a long time ago, but I'll be happy to answer any questions you might have. I'm sure some of you might be a little bit nervous about the markets right now, but I'd be happy to answer your questions for you, even some of the positions you might be into, and give you a little bit of a feedback or whatever you might be wanting after this is over with. So as I get started with this, let's go ahead and throw a disclaimer, because I will be looking at some live charts today. I want to make sure that whatever I do cover, that you understand is simply for educational purposes for you tonight. I'm not telling you to go home and make these trades, whatever we might take a look at, or investments. I'm just doing them for educational purposes, so you have a better understanding of how the markets work, so you can see how then you might want to put that into practice with your own portfolio. All right. And I think that's it. My goal for you tonight is to really teach you how to grow your wealth, is because one of the things that we're just really not ever taught how to do, what we are taught how to do is really to go out and get a job. And so my goal here realistically is to show you how you can use the market to either grow your wealth long-term, or if you wanted to use it for shorter term purposes, but really to process information like a professional, profitable trader, and not just somebody who, I heard somebody say this, I want you to go back and understand it, because when you understand it, you know then what your options are and how it actually really affects you. So wealth creation, and just kind of bear with me a little bit, but everything I'm about to show you here, 3 or 4 slides in this, will move us into longer term investing, but I have to get into kind of the mindset here first. Most of us are taught that if we want to, create any wealth, we're going to have to go out and get some type of a job. Go out and get a job, and that's how we're going to try to get ahead. And that was probably more so our generation, not so much the kids' generation that we have. Like if you have any kids right through now, that's more so our generation. Go out and get a job and work really hard, climb the corporate ladder. Hopefully it'll take care of you and go back and retire. We also have the financial markets that are available to us, investments like our 401ks, IRAs, real estate, invest in real estate as a side business, or even own your own business. And these are really the 4 main wealth creation modules that most people use in the US today. The ones that most people like, are the ones that people seem to do more often, would be go out and get a job, because we're taught to get a job from a very, very young age, or real estate, because most of us grew up around some type of real estate, whether we owned or rented. We grew up about real estate, so we understand that process more. When you go to school, they teach you how to get a job. They're talking getting a job, and because we grew up in real estate and we want to get ahead, we think, well, maybe I'm going to go ahead and buy some type of real estate to help grow my wealth longer term for exponential rates of returns. And those are 2 that most people use. I like all 4 of them, but there's reasons that people use those ones that they're after. Owning your own business, for instance, that's a great way to actually grow our wealth, but most people don't do that. There was a recent study done by the Small Business Administration, which said 79% of companies that go bankrupt do so because they don't have enough cash, and that's why they run out of, or they actually go bankrupt. But the problem with owning your own business is most people never really learn how to own their own business. They just think, I've got a great idea, I'm going to go ahead and try to do this myself, and they just grow into it organically, but they're not really ever taught how to do that. Could you imagine if your money manager that you had, or somebody that was running a major corporation, just said, I don't really know how to do this, I'm just going to grow into it organically? That's usually not what happens. They go through a major school with some type of training in that, and then they get on-the-job training with what they're doing, and they learn how to do it. But most people don't know what they're doing. They don't own their own business. They have poor marketing. They don't know how to manage their work and home life together, so they run out of time. They try to do it all by themselves. They don't delegate. They don't have enough training. They have no business plan. They have a product that doesn't stand out from anybody else, but they think they do because they don't know any better, or they just have a really bad location. And this is why most businesses don't work for people. They don't know actually how to start their own business because they just don't have a business plan to kind of work through all of it. Real estate is kind of a nice one, and I like real estate, and I'm sure many of you online with me tonight have some real estate. But the problem with real estate is once you buy your first property, and we're just taught to do it one way, unless we've taken some type of training, you've got to save up enough to put 20% down, and then you buy that piece of real estate, and then you put a renter in there to help pay the bills. But if that real estate you bought was already at a high price, maybe you live in California right now, and that property you're going to buy, even when you put a renter in there, doesn't quite give you positive cash flow to pay the bills. It's hard to buy a second property, and you get stuck with just one. Other problems with real estate, you've got renters, you have repairs, vacancies, insurance costs. People forget about the fact you still got to pay insurance on that property, yearly taxes on that property. You have late rent, lawsuits, high commissions when you turn around and sell it. These are some of the reasons that people say, well, maybe I won't buy real estate and I'll just keep my job. And again, it's just another way that we lose what we're after. Financial markets, not enough cash. I want to buy 100 shares of Apple at $200 a share, $250. What if I want 1,000 shares of Amazon when it was trading around $2,000 a share? How do you buy 1,000 shares of that without going out and spending too much money? You just don't have enough cash to actually make it work for us. Stock market have fast drops. Anybody have any fast drops in your portfolio last couple of days? Or no training. We're not taught to actually invest in the stock market. And yet we've been told from a very young age, put 10% of each paycheck away. We just don't do that. So what do we do instead? We work for a job. Problem with a job doesn't give you enough cash to actually retire on. You have to work too many hours, fixed pay. You only get what you get. You can be fired for any reason whatsoever. No exponential growth. You might not ever get hired at the job you want, office politics, and the commute. So all of these things in wealth creation have problems with them, but yet most of us just stick with just the job. And it's the one that's going to pay us the least, and that's one we all just kind of stick with. And we don't go out and really look for the other three to do them actually correctly. We just chase things to get out. And what we should use all four of those. When you're using all four of them, you don't have to worry if one of them doesn't work out. Think of it like somebody investing in an apartment building. 2 people move out, but you got 50 more units. We're still okay because we're using multiple streams of that money coming in for us. So what are we going to do here? And then we're going to move kind of into the investment side. And I'm going to focus more on the stock market side because that's what this is after. But realistically, if we're going to be successful, we should try to have some form of all four of these to get us to our goal. And my goal isn't to teach all four of these right now. My goal is to really talk about the stock market. And again, I'll answer any questions as you go through this as well. So this is data from a 2015 study from the San Francisco Federal Reserve, the San Francisco Fed. Those of you on the West Coast, Fed. From 1870 to 2015, U.S. real estate's annual growth was 6.1%. So if you had bought homes in between 1870 and just held on to it from 2015 around the country, you would have averaged about 6.1% return on your investment. Stock market growth over the same time frame was 8.5%. And yet people don't think about the stock market. They think, I'm going to invest in real estate instead. For the simple reason that you don't grow up around the stock market, but you grew up in some type of real estate. And so we're going to move towards real estate. And so that's what most people do, but they don't understand that the stock market has so many more potentials. How many people do you know that want to invest in real estate versus I want to invest in the stock market? And yet the money's with the stock market. Currently, as of first quarter, going through here right now, the U.S. stock market is worth about $30 trillion. $30 trillion, that's the value. Take all the stocks on the U.S. stock market and combine them together, it's worth about $30 trillion. Then you add the bond market, was another $40 trillion. Just 9.5 of that's mortgage-backed securities for real estate. That's $70 trillion in the financial markets. And that doesn't even include currency, which is 10 times larger than the stock market, 10 times larger, or the commodities market. According to first quarter 2019 Zillow, the U.S. housing market's worth $33 trillion. Now, if we look at these, which market is a little bit larger than the other one? And if I really want to make money, why don't I actually go where the money is? If you want to buy real estate, you're probably going to get a loan. Well, where are you getting the loan from? You're getting a loan from companies that are publicly traded, the financial markets. So why don't I just start with where the money is to begin with if I really want to make some money? So if I want to make some money, let's start where the cash is at. Here's some profits from just the US banks. And this will tie into where this whole course is going to go to here tonight. This is just from the last 12 months. JP Morgan Chase made $25.3 billion. These are the profits, $25 billion. Morgan Stanley, almost $7 billion. Bank of America, $9 billion. Goldman Sachs, $5 billion. BlackRock, which isn't a bank, but which is an investment company, made $5.3 trillion. Trillion, not billion, trillion. Wow, it's the largest investment in the US, BlackRock. Wow, that's just past 12 months. If I want to make some money, why don't I go where the actual money's at? So where do these banks make all their money? Fees, we all know that. Banking, credit cards, debit. If you want to put cash deposits in the bank, how many of you guys know that if you own some type of merchant account, you want to deposit cash, they actually charge you to deposit cash. Did you know that? Because they don't want you to take cash. Overdraft charges, ATMs, late fees, loans. Banks get loans from their depositors. They take money in from their depositors and they loan it back out to the depositors. The Fed, banks get loans from the Federal Reserve and they loan that money back out in the form of credit cards. Investing, and here's where the money's going to come from, which we're going to go to, investing. Banks invest the depositors' money and the Fed's money. So they take the money that they get from the depositors and they reinvest it to make their profit. And if we want to make money, we need to go back and copy what the successful investors are doing instead of what they're telling us to do. Now, how many of you have been told from anybody that's in the stock market or anybody who's managing your money that the only way to make money is just to buy and hold on to something? And when you buy and hold, when do you make your money? And let's be honest about it. If you buy and hold, when do you make your money? And this is the part where you guys can actually go back and type in a question just when the question is and answer something. And the answer is you don't make any money when you buy and hold because you only make money when you sell. Yep, that's correct, Susan. You only make money when you sell. Now you can buy and hold and it can go up in value, but if you hadn't sold, let's say you bought something 3 months ago and it went up and the stock market's hit all-time record highs across all 3 indices last week, about 2 weeks ago. Now, had you not sold when that happened, where are you at today? Back down to where right now the S&P is at 0 profit for the year, as of yesterday, not as of today, but as of yesterday. So you didn't make any money because you bought and held. You only make money when you go back and sell. So how do the big banks then make money if they're telling you to buy and hold? And the reason they're telling you to buy and hold is because what do you think the banks are doing when you buy and hold? Now remember, you put your money in their accounts. They're using your money to invest the correct way, not the way they're telling you. They tell you to buy and hold, but then they go back out and reinvest your money. And they borrow money right now from the Fed at 1.5 or 2%, and they reinvest that money the correct way, and that's where they make their profits at. So what we want to do is we want to go back and just copy what they're doing, not what they're telling us to go back and do. So JP Morgan, CEO of JP Morgan, Jamie Dimon, his salary last year was $31 million last year. Just one person, $31 million. State Street Bank, $24 million. Look at Goldman Sachs. The president and chief operating officer last year was paid $72.5 million. The chairman and CEO, $70 million. The chief financial officer, $58 million, and chief administrative officer, $49 million. Those are just 1, 2, 3, 4 people at Goldman Sachs. Not the other thousands of employees they have or the bonuses they have. That's just those 4 people. President and CEO of Merrill Lynch, $27 million. My point is, this is a lot of money. How are they making all of this money when you, on average, now we go back and say, what did we make on average when we go back and say, what's the stock market do? Well, the stock market on average was up 8.5% per year every year during this time frame. So how did they make all of their money when the market's only up on average around 8.5% a year every single year? And the answer is because they didn't do what they told us to do. They didn't make their money because they bought and held. They invested the correct way, and that's what I want to go back and teach you how to do. Fund manager pay. You thought that was a lot of money? Now you can barely see this one up through here, but Michael Platt got paid $2 billion last year. That's $2 billion. That was his salary last year alone, $2 billion. James Simmons, $1.8 billion. David Topper, $1.5 billion. Ken Griffin, $1.4 billion. Billion with a B. This is just one person's salary for 1 year. There's a lot of money in the stock market. So if there's all that money in the stock market and it's much bigger in the real estate market, why don't we actually say, if I want to make some money, why don't I go to where the actual money is? Why go someplace else? If I want to make money, let's go where the money is. That's what I'm trying to get to here. So I want to actually teach you to invest the way that they invest. And the way that they invest is they take your money, we invest, we give it to them. You give your money to a mutual fund manager, and he puts that money in a big basket and he buys a whole bunch of stocks. He gives you a percentage of the stocks. Whether those stocks go up or down, the mutual fund managers are making money because they're taking the value of those stocks in their account and they're reinvesting the correct way and making the profits. And I want to teach you what it is that they're doing. Now, if that mutual fund goes up or down, they still get that big bonus, $2 billion per year. That's just one person's salary in 1 year, 2 billion with a B. The reason they do that is because they're reinvesting the correct way. I'm going to teach you what it is they're doing so that we can go back and try to make that same kind of money. So they're trying to buy pre-IPO stocks. Think of it like venture capitalists. How do we make money before a stock ever gets to the stock market? And I'm going to teach you two ways here. How to make money before it gets to the stock market, and if you missed it, how do we make money when it's actually at the stock market? And those are the two items we're covering in tonight's class. If you want to think of it a little bit, I'll tell you, the stock market, whether you know it or not, is a little bit rigged against you. Not in a negative form, but it's rigged against you. You're not meant to make money. Everybody else is meant to make money. So if you give your money to a mutual fund manager, they put it in a big basket of stocks. If those stocks go up in value, you make money. You pay them a percentage of the profits and fees, but then they reinvest your money the correct way because they might have a mutual fund that's worth, let's say, $400 billion with a B, 400 billion. They're just taking that money because it's in their account and using it as an asset to reinvest the correct way in other new startup venture capitalist firms, taking other companies public, and that's where they make all their profit at. So whether their mutual funds go up or down, they're still making a profit. So if it goes up, they make more money in terms of percentage of profits and fees, but they're reinvesting your money the correct way and making a profit. If your stocks in the mutual fund go down, you're still paying them a fee and they're still reinvesting your money and they're still making a profit. Who's the only person that loses money in that mutual fund if it goes down? It's just you. Now, once you buy that mutual fund, they give it to you and you have a ticker symbol. You take that mutual fund, you put it in your broker's account. Now, your broker has that ticker symbol in their account. You're going to pay them every time you buy or sell that mutual fund a commission. Now they hold that mutual fund in their account because it's not in your bank account, it's in their account, their brokerage account. It's your brokerage account, but it's their brokerage firm. So the value of that asset is in their account. Now, what do you think they're going to do with the value of that asset? They're going to reinvest the correct way like the mutual fund manager is doing, and they're going to keep the profits. Hey, Kendall, you're back online.
Could be.
Okay. Yeah, Kendall, can you hear me? Kendall. Kendall? Okay, Kendall, I don't know if you're back online, but anyway, I can hear you on there. I think everybody else can too. So anyway, they take the value of that mutual fund and they reinvest it the correct way, and you still pay them in that brokerage account. Now, if your mutual fund goes up or down, you still pay them commission, and they're still reinvesting your mutual fund, which is in their account, their brokerage account, and they use the value of that account to reinvest the correct way, and they make their money. And again, who's the only person who loses if it goes down? In this entire scenario, you are the only person that loses if your mutual fund goes down. It's rigged against you, and the whole financial system needs you to be the one who owns the asset so everybody else can make money off that asset. And that's where we're going with today. All right. So extra noise, I think the extra noise is gone. It was just Kendall. I think he just left up there.
It's
okay.
me. Yeah, it's usually me.
No problem. Okay.
Sorry.
Yeah, we're good. All right. So now, what I want to look at today is how do we get a stock pre-IPO? And if you missed it, how do we get in once it's already out there? And that's what the big brokerage firms are doing. They're taking the value of your money and they're reinvesting. They're buying other companies as venture capitalist type of firms, and then they're reinvesting that money and keep the profits. And when they go public, they sell them off, and then they just start all over again. So if we're good with that, let's go ahead and kind of get into it. So what are pre-IPOs? The best profits as an investor come from pre-IPOs. How many of you guys ever watch Shark Tank? You like Shark Tank? Great show. I think everybody likes to watch it. How many times have you been watching Shark Tank and somebody comes out with a fantastic idea and the first thing you think of, man, what a simple idea. That's a great idea. I really like that. And then the second thing you think is, well, I'd like to invest in that company. You ever thought about that before? Someone comes out and says, I just want $40,000 for 25% of my company. But they just want enough to kind of get the first order started because they have to have enough money to start the first order. They have to buy enough product to get it cheap enough. And you're thinking, man, I would buy into something like that. But we're not able to buy in that because they're not pitching to us, they're pitching to the sharks. So pre-IPO is like Shark Tank, where you're the actual shark and people are pitching to you. If you really want to invest and make the money and you've got some risk capital, some of that money should go into startup companies. Now there's some risk with that. We'll talk about just a little bit here, but to be able to buy a company before it actually goes publicly traded, you're buying it at a much earlier price. So pre-IPO, this is a small portion of the IPO shares are usually made available to private investors. So there's two ways to do that. One is in the form of crowdfunding and PIPE, which is private investment public entities, which just means you're buying a newer company. So let's say that you start your own company and it's a small company, you got a great product and a great idea, and it's gonna really just revolutionize things. And you'd like to kind of get started with that. But because you're a private company, no big investment firm, no Merrill Lynch, no Goldman Sachs, no JP Morgan, no big huge venture capitalist firms are gonna give you a lot of money to get started because you're so small and so new. And so you're just not worth their time. It's like you finding $1 on the ground and picking it up. And that might be kind of cool. But if you see a billionaire who finds $1 on the ground, yes, it's $1, and they might still pick it up, but it's not going to make that big of a dent in their portfolio if they can see, oh, there's a $5 million pile of cash over here or $1 over here. Which one do you think they're going to go to? Well, they're going to go to the $500 million pile. Well, for newer companies, when they're so small like that, most big companies won't look at them. So they do what's called private investing in public entities or crowdfunding, which means that they're looking for money from people like us to get started. And that's really what we're talking here, pre-IPO type of stuff. Buying into a stock when it's so small, hasn't become publicly traded yet, so the share price hasn't yet exploded to the upside. So getting into it nice and early. So if you're watching Shark Tank and you saw the lollicups, did anybody see this item right through here? Nice item. If you look at this little cup right here, the little sippy cup is on a swivel. So when the kids grab the handles along the sides of the handles and they move back and forth, they tilt it sideways, the sippy cup always stayed right side up because it swings like a regular swing does. So it never really went upside down and the kids didn't spill their sippy cups. So the Shark Tank's, one of the investors invested $100,000, it was Robert, and he owned 40% of the company for a $100,000 investment, got 40% of the company. In just the next 18 months, they did $2 million in sales. $2 million in sales, and Robert owned 40% of that company with a $100,000 investment. That's a pre-IPO type of stuff, and that's really where the real money comes from. It's not because you bought a stock and it went up 8% that year. If you buy a stock and it goes up 200, 300, 500% that year, that's really what it is we're trying to accomplish through here. How about Wicked Good Cupcakes from Kevin O'Leary? Great one. He invested $75,000, doesn't own a piece of the business, but he gets 45-cent royalty on every cupcake sold forever. And they did $15 million in sales in the first 4 years. $15 million in sales, and he gets a 45-cent royalty on every cupcake forever. Wow. Tell me that wasn't a great investment, 75K. How many of you guys would have paid the 75K for that? Even if you didn't have it, you go out and get a loan for it. That's a pretty cool investment. How about Groovebook? Everybody remember seeing this a few years back? $150,000 investment for 80% of the licensing fees. After the investors, Shark Tank investors paid $150,000. I think it was Mark Cuban and Robert at the same time for 80% of licensing profits. 2 years after they paid the $150,000, the company was sold for $14.5 million. That's a great investment. And these are all done pre-IPO, things that we aren't available because these people weren't pitching it to us. But we've got to start to look at some of these items. And when we start looking at some of the crowdfunding and the pipe items we get into, private equity ones, we get into it not for 150 grand, but you can get into it for 500, 1,000, 2,000, 10,000, 50,000. In little smaller chunks, it's available for the average investor. But these would be longer term investments that we're after. How about the next one here? How about Tipsy Elves? Remember those ugly t-shirts that people had for Christmas time? $100,000 investment for 10%. 5 years later, the company's done more than $57 million in sales. What a great $100,000 investment. Yep, I would buy them too, absolutely. How about Squatty Potty? When that first came on, how many people were laughing? Those are the things you put next to your toilet, and when you go to the bathroom, you put your feet up on it so you can go to the bathroom a little bit easier. $350,000, 5 years later, they've done 41 million, I'm sorry for laughing, but $41 million in sales for that little piece of plastic. That's it, $41 million in sales. Tell me that's not crazy, right? Scrub Daddy, you guys seen this one here before? Lori invested $200,000 for 20%. They've done over $60 million in sales, and all she paid was 200 grand for that. So what if you didn't pay 200 grand? What if you only paid $20,000? Well, your 20,000 would be the same thing as a stake for $6 million in sales on a $20,000 stake. The point is, these are types of investments we want to take a look at, pre-IPO type of stuff. Now, I don't have a lot of time to get into how all the pre-IPOs work tonight, but Apple, currently worth $890 billion. Before it was ever publicly traded, they were looking to raise capital from individuals, employees of the company, friends and family. It's worth $890 billion. What if you could have bought into Apple when it was only worth about $5 or $10 million when it very first came out? and someone said, hey, I've got this great company. Well, back then they didn't have the same crowdfunding sites and pipe sites that we have available today, but they have those now today where you can actually find these companies that are only worth $1 million, $500,000, $3,700. So just tiny little companies, but you're able to get into some of these and you buy and hold onto these companies until they finally go public. Uber just went public and they're already worth $66 billion. Microsoft, $1 trillion. Netflix, $136 billion. Airbnb is still a private company, but it's already valued at over $35 billion. But at one point, it was a tiny little company with just one employee, 2 employees, 3 employees, and they're looking to raise capital. Did you put yourself out there as somebody who's willing to loan money? Or did you say, I don't know anything about that, I have a job because I've just been taught how to get a job? What have we been focusing on? We've been focusing on the wrong items. If I want to truly be wealthy, I've got to go where the money is. So if I'm looking at some of these items here and I want to go where the money is, if I'm going pre-IPO, there's a couple of things you might want to write down. And as I get more time, and we can do this maybe on a follow-up webinar or on our next event that I have coming up, I can talk more exclusively about how each of these work. But pre-IPO checklist, one of the things you're able to do, because they don't have to give the same information as a public traded company, some of the items I'm after here, I want to say if I'm thinking about buying a company before they're ever public, when they're still private, I want to look at who's the executives, who's on the board members. In other words, who's running the company? Do they have a history? Where did they come from? So some of these companies, when you watch Shark Tank, you'll hear Mark Cuban say, I want to go ahead and, yes, I'll go ahead and pay you $100,000 for 25%, but I want a board seat. In other words, I want to be on the board and I want to help guide the company where it's going to go. So who's on the boards of some of these companies, even though they're still privately held companies? And so you can do some research on the board members. Even though it's privately held companies, you can still find out who's on the board and who's running the companies, because they'll have those on their websites. And go back and just do some research. Has this person been successful in other careers, other jobs, other board places they've been to? Who is the person on some of those boards? What industry is into? It's like, for instance, right now, if you're looking at an industry that's really hot, we might be thinking like artificial intelligence, self-driving cars, things like that. What are some of the better industries that are out there? Maybe some type of medical research type of stuff. This company have a really good drug that they're trying to go through trial stages right now, but they're not publicly traded just yet. They're still privately held. Is it a new service for the public? Is there something really cool? In other words, what I'm trying to say is, are they just going to say, hey, we're going to open up another restaurant, whether it's Chinese food, Mexican food, Italian food, pizza, whatever it might be. I'd like to open up my own restaurant, and I'm just looking for other investors. Well, is that something that's going to turn the industry on its ear, and people are going to want to go into this new restaurant, or is it just another restaurant? Or is it a new restaurant that the person who run it before has run 15 other very, very successful restaurants and taken all of those restaurants public on each one of those and sold them off to other larger restaurant chains? Does that make sense? In other words, what's the service out there that I'm trying to buy into? Or is it just something that's a good idea, but it's never really going to be a real company? You hear that on Shark Tank quite a bit. That's a great product, but it's too early to be a company. And so in other words, stay away from that. Is the company currently profitable? If I'm trying to look at some of these IPO stocks I'm trying to buy into pre-IPO, is the company currently profitable? And you'll know that because they'll put out what's called a private placement memorandum, a PPM. And so they want you to invest in their company through crowdsource funding or through PIPE, which is similar to crowdsource funding, but they're trying to raise money. These are tiny little companies that are so small that the big banks and Wall Street won't loan them any money yet. So they come to people like us and say, hey, I'd like $1,000, I'd like $5,000, I'd like $200, I'd like $20,000. And they're coming to us looking for money to help them grow their business. So one of the things they'll tell you is, are they actually making money currently? And if they are, that's a good sign. If they're not, and they're actually burning through funds, which is why they want your money, how long could that last before they go bankrupt, before they get your cash? Social buzz, are a lot of people talking about it. Anybody talking about it? Anybody talking about Airbnb right now? Not even publicly traded yet, still privately held, but everybody's talking about Airbnb. So what's the social buzz? You hear it on Twitter, Instagram, Facebook, wherever else you see, are people talking about it? These are all things that if I'm going to look at a stock before it's an IPO stock, how do I do some research on it? Are there any other investors who are investing in it right now? Who's investing in it right now? You know, if I hear that, you know, there's a nice big real estate company and I hear that Barbara from Shark Tank is investing in something like that, well, she's got a good handle on what's going on there. Maybe I'm interested. So who else is investing? So those are some items you can go back and take a look at to buy into a company before they go pre-IPO. There's also some items here, the comparable company analysis and the discounted cash flow, which I'd like to get into on a different webinar, but this is how you go back and really fundamentally evaluate the company versus just the basic checklist I just gave you. And this is enough to kind of get you started. But if you're going to only invest, 200, 500, 10,000, maybe up to 20,000, 25 grand, this is enough right here. But if you're going to put a big chunk of money out there, or if you're a big venture capitalist, you're using one of these two forms here, the CCA or the DCF, discount cash flow. And I'd like to cover those on a different webinar, but just know those are out there for you. Risks of these pre-IPOs, they're harder to evaluate. And by the way, you can just do a web search. There's about 15 different good companies out there, websites right now, that talk about pre-IPO and how to invest in these crowdsourced funding and PIPE type of stocks out there. And you can buy shares of stock in some of these for $50. And they're just smaller companies that haven't really gone too big yet, but they're trying to get big enough so they can finally get into an IPO. Harder to evaluate. The company. One that I've been looking at recently, it's a brand new one just coming out. Here's ISM Club. But there's a whole bunch of them that are out there, and we can talk about those on a different webinar, how to actually get into them. But there are some risks with these I want you to be familiar with. Harder to evaluate the company, no SEC reports. Officers and directors are not required to disclose any information. It's private, they're privately held companies, so you can't go back and do any research, real research, and find out what the analysts have all looked at the companies privately held. It's not as easy to sell your shares. So if you wanted to sell your shares, like on the open stock market, sell, and it'd be sold right off the bat.
Sorry, we got some feedback there, Don.
No
I think we
come on there. Is that you still can? Okay, and the company may never make their IPO. So it might not ever make it to an IPO. Those are just some of the basic risks. So that's the first part. So if we're going to invest, and I'm just getting some feedback here. Kendall, are you still on?
Yeah, I'm still here. I'm going to call Don right now, let him know he's got his mic off mute.
Oh, okay. These are some items that are, if we're going to invest pre-IPO, that you want to go back and look at, and we can talk about those at a further item or further webinar. But I just want you to know that if I want to make some money, I just need to learn where the money's at. I don't want to get a job and think the job's going to take care of me. I want to learn where the money's at. So if I get past that, we're going to move into today. If you didn't get to pre-IPO and we got into today's stock market, what should I look at now? And I'm going to go back and take a look at the same thing that investors look at. I'm going to look at the market fundamentals as a whole and as an individual. In other words, if I'm going to be investing today, those of you who have an IRA or a 401k, or you have your own individual brokerage account or a joint account, or you can even have a brokerage account for your company, your business, that's okay too. But I'm going to invest as an individual, I'm going to look at kind of the same information, but the information is much easier to go back and get to. Number one, I want to take a look at the fundamentals of the stock market. Now, for those of you who are in the stock market right now, you probably saw the stock market drop over just the last couple of days. And you're thinking, what does that mean for me? Well, I'm going to pull up a little spreadsheet I just did here really quickly. And this, if we take a look kind of going forward here, this is the S&P 500. Now, the S&P 500 is the benchmark for the entire stock market. For those of you who are new to the stock market, hopefully most of you aren't because you logged on to a stock recording webinar tonight. S&P 500 is the benchmark. It's 500 of North America's largest companies in one big basket. It's your Apple, your Amazon, your Netflix, your Google, your Facebook, your General Electric, your John Deere tractor, your Walmart stores. It's 500 of the biggest companies all across America is one basket of stock. If we go back and if we look at this, we'll go back all the way to 2006. This would be fourth quarter 2006, first quarter 2007. These are the actual earnings per share. If you take all 500 stocks together and say, what was the earnings per share as the group? And you can see what the earnings per share is. Think of the earnings per share as another way of saying, what is your paycheck? This is a real quick, simple way to look at this. If you had a job and you got paid, and after, can I share the spreadsheet with you? It's just one that I put together tonight. It's just, I just did it really quick. I just went off of a website here, my website, and just got the information. But if you take a look at it just real quick, and you can record this, I'll just kind of scroll down and leave it here for just a second on each one. Just, you can go back and just screenshot it. Right in here. So I just went through the entire thing through here, but you can just watch the webinar again, screenshot each one of those. But here's how it works. Here's all I'm after here. In other words, the earnings per share, if you had a job, paid all your bills, after all of your bills are paid, did you have any profit left in your checking account? And that's all the earnings per share. It's just profit once everything's paid. What is the actual profit per share, earnings per share? So on average, if we go back to the fourth quarter of 2006, the earnings per share of the S&P 500 was 20% or 20 cents per share. Then 23 cents next quarter, next quarter, next quarter, next quarter. And you can kind of see that we had some nice profit coming through here. And we always made a nice profit all the way down through here. There was always a positive number on the earnings per share, but we had some decreases at different times coming through here. So we had some decreases where you can see that here we had Q4 2008, we actually had a negative number here at negative 23, where the S&P 500 companies actually lost money, and they did that on purpose. They didn't necessarily lose money, but they were holding some of their, I guess, bad news back until everybody had a bad quarter, and then they released the information. Another way to do that is it's like saying, yeah, you've got some bills, you haven't really quite paid your bills just yet, so you're waiting for a really bad time, and then you put those in and said, oh, we had a really bad quarter, we didn't make any money this quarter because everybody else was doing the exact same thing. And you didn't want to do it when everybody else was doing really well, and all of a sudden you said, well, I have some bad write-offs here, and I'm just going to write these off. You don't want to have a bad quarter when everybody else having a really good quarter, because everybody will sell your stock. So when did they do it? They all did it at the exact same time, right in through here at the Q4 2008, where they all just got rid of all their bad write-offs, and everybody just dumped them at the same time. Everybody had a bad quarter, so they didn't look really bad because everybody was really bad. But what I'm after isn't so much this number right here, which is the earnings per share quarter after quarter after quarter after quarter. What I'm after is, what is the year-over-year return? This is the number I'm after, and this is what's important in today's marketplace. So if I'm going to be an investor, and we're not talking trading here, we're talking investing, just like pre-IPO. If you buy a pre-IPO stock, you're buying to hang on to it for a while on a pre-IPO stock. And so you want that to grow, 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 grow. So when they finally become public, and then they just burst out, and you're up now at like an 800 or 900% return on your money, you can go back and sell then. Investing is the same thing here. So what I want to know is, what is the year-over-year return? Year-over-year return. So if I go down to where we are currently, right in here right now, at Q1 2019. This is Q1 2019. Year-over-year return is 5.72%. Here's what I'm after. This number here is 3502. That was the earnings per share the first quarter out of all 500 stocks. That was the earnings per share, $35.02 per share, compared to 3302 right here, 3302 for the Q1 2008. So 3302, and the current one was 3502. We're up 5.71% year over year for the exact same quarter. Now, to go back to you as a job, if you have a job, and I'm doing this because this will make sense for you guys who have an IRA or 401k or long-term investment portfolio here. If you have a job, and at the end of this year, you paid all of your bills, you still had more profit than you had last year, would that be good news for you? Yeah, hopefully you guys are thinking yes, yes? Because I'm thinking yes. So this year, if you made this just the first quarter so far this year, if the first 3 months of this year so far, you already made 5.71% more than you made last year at the same time, that'd be good news, yes? So what I'm after, as long as these numbers are positive, 2% increase, 8% increase, 22% increase, 20% increase, this is this quarter versus the same quarter a year ago. Obviously, you can't compare Christmas time with January, February, March. So you want to compare the exact same quarters from the same year ago quarter. So we're up 5.71%. So in other words, even though we have all of this negative news with trade talks and trade wars and all this negative news out in the stock market, everybody's trying to hurt everybody else politically, both sides are doing it through, get all this nasty information, we're still expected to make money versus where we came from. So that's what we've already done. Now, since this only shows me the past, and I can see that we're already at here, I can then go back and take a look at Q4 2019. This year, we're still expected to be 5.8% at the end of this year. We're expected to be 5.8% above where we were last year at the same time. This is based on every analyst that follows the S&P 500 stock. So you take every single analyst in the entire country that follows any of the S&P 500 stocks and say, what are they expecting the overall stock market to do? And of those analysts that follow the stock, they're expecting the stock market to still be up 5.8% above at the end of this year where it was last year. Now, last year we had a fantastic year, just in case you didn't know. This year, we're still expected to be up 5.85% above where it was last year. I think, well, that's pretty good news. So no matter what kind of information you're still hearing about the stock market, it's still expected to make more profit this year before the end of this year than it did last year. And going forward at the end of year 2020, so the Q4 at the end of next year, we're still expected to be 9% above at the end of this year. So despite everything you're hearing, despite all the negative news out there, every analyst that follows all the stocks, whether they trade in China or just here in the US, the stock market is still expected to be 5% above where it was the previous year at the end of last year and 9% above where it's supposed to be at the end of this year. they're still expecting growth. Now, if you own stocks in your portfolio, would you think that's a negative or positive? And you're thinking, but I hear all this negative news. And you hear negative news for a reason. And the reason you hear all the negative news is simply because it sells advertising space. That's what I'm trying to get you to head. Think of it in politics. Whether you like President Trump or not, what have the newspapers and the advertisements been saying about him? Simply because it sells advertisements. Yeah, it could be true. It might not be true. It's not my job to say. But you see all the negative news because it provides advertising space. You watch CNBC television, and within every 30-minute spot that comes on CNBC television, somebody will tell you exactly why the stock market has to go up. And in the same 30-minute spot, somebody will tell you exactly why the stock market has to go down. Why? Because they want to sell advertising space. And if I believe the stock market is going to go up, I'm going to listen to the guy who says it's going to go up. Yeah, I'm going to agree with him. But if I believe it has to go down, I'm going to listen to the guy who says, oh, it has to go down. So if I believe that it has to go up and all they put on CNBC is it's going to drop, it's going to drop, it's going to drop, what are you going to eventually do? You're going to turn off the TV. So you hear all kinds of garbage in the news, and I'm trying to get you to get to the point where you don't have to listen to the garbage. It's just white noise. I need you to understand what makes the stock market go up and the stock market goes down. And based off of every analyst that's following the S&P 500, at the end of this year, they still say it's still expected to be 5% above where it was a year ago. Now, it's not the huge gains that we've been having through here, 30%, 21%, 10%, but it's still a positive number. And all that means is fundamentally these stocks are making more money. So if your house is going up in value every year, like if this is your house, and it goes up another 5% at the end of this year and 9% next year, don't you think that means you should be able to sell it for more money? Yeah, that means the stocks in there are being worth more money. And that's what we're trying to get through here. Now, these numbers are updated every day by the analysts. Every time an analyst makes a change to the S&P 500, these numbers get updated every day. This is where they were at the end of today's trading day. Now, they might only be worth 5.04 or 5.85 or 5.86. They might only go up maybe 1/10 of 1%, on a week, but they're updated every day. And so the point is, if I'm thinking about investing, forget about the white noise. I need to know what causes the stock market to go up and down. And if the value of those companies, they're making more money once they pay all of their bills, that's earnings per share. What's the money that's left over once everything's paid? And if that number is positive and the number is increasing, that means the value of those companies are still making money. So regardless of what I hear about what's happened with the trade wars, the S&P 500 is still expected to make more money. Now, the reason it's not as high as it was previously is because some of the stocks that have exposure to China aren't going to make as much money. But the stocks that are still here in the US, our economy in the US is still growing. Our unemployment is still extremely low. We still have companies making good profits. Nobody's taking money and put it into the bond market right now because the 10-year bond is under 2%. Nobody wants less than 2% when they can put in the stock market and get a minimum of 5.85%. So everything in our economy is still really positive for just the US marketplace right through here. And my goal is just simply saying, if I want to invest, I need to understand what makes the market goes up and down. I don't want to focus on what everybody else tells me because I'm a follower. I don't want to be a follower. I want to understand so I can make decisions from my personal investment account. Any questions on what I just covered here? This is a big one here. Fundamentals. This is just what it's expected of the stock market. So if you take some screenshots here, I just don't know how to get it to you. If you send me an email after class over mike@invest-edu, I'll send you this little spreadsheet here if you'd like it, mike@invest-edu.com. But this is where we're at so far for the last few years, last 15 years or so, and we're still expected to grow. So I only showed you that because if I'm going to be investing, whether it's buying stocks pre-IPO, buy and hold, or I'm trying to invest my longer term portfolio, should I be selling everything right now? Should I be moving to cash right now? What happens if my fund manager who's managing my account doesn't know the answer? He tries to tell me something because he wants to sell me something. And I get that. I'm an educational company too. I don't mind people selling me something, but if you don't know why you're buying something to better yourself and you're just buying because someone tells you to buy, that's a bad scenario here. And I want you to be an informed investor so you know where to put your money going forward. I'm not going to say we're not going to have big drops because we just had a big drop in the stock market. But at the end of this year, if we're expected to grow almost 6%, I would expect the stock market to be higher at the end of this year than it is today. And I would expect the stock market to be higher at the end of 2020 than it is at the end of 2019, unless those numbers change. So everything still says we're heading higher. So anybody got questions on that portion before I move on? Maybe I'll just take a look at a couple of good stocks here that you guys might be interested in as I move forward. but we wouldn't know the projection year-to-year return. It's easy to get to. There's a lot of places to get to it. If you're on my website, for those of you who actually have access to my website, one of the places you'll find it, and I might have to relog back in through here. I'm not selling the website here, but it's just one place you can find it. I'm sure you can just do research as well. Go on and just do a quick Google search and say expected growth S&P 500 2019 and 2020. I'm sure a Google search will come up with that number quite easily for you. On my website, it's just right down through here, and it just says this year's growth percent estimate on the S&P 500. That number comes from right here for this year, and that number right here for next year. So that's where the numbers are at for me. So I have them on my website. It's really easy to get to, but I'm sure you could just do a quick Google search and get to that, Patrick. I don't want you to say that you have to buy something from me to get the information. It's out there, and I'm sure you'll find it pretty quickly, pretty easily. All right, email Mike. It's just Mike at my website right up here. It says invest-edu. Put the .com, but I own the company, so it's just Mike at. All right. So let's take a look at a couple of good stocks that I found, and then I'll just open up some question and answer for anybody who might have some questions here. But if I'm going to invest, I need to make sure I'm investing in some good quality companies, whether pre-IPO or after IPO. An IPO just stands for initial public offering. It's the very first day a stock can be bought by us when it's traded on the stock exchange. The initial public day, public, that's us, the day the stock is offered on the stock exchange. So a couple of nice looking stocks you might want to take a look at here. And again, if you're investing right now, you want to try to stick with stocks that are a little bit more domestic. In other words, they don't have a lot of products that they sell to China. Now, services are okay. If the company you're looking at is a US company and all they have are services in China, those aren't being taxed on the tariffs. It's the products going that are being taxed on the tariffs. So if the company has just services, they don't really have a product, let's say that they're some type of an IT company, that would be fine if they have global exposure worldwide. But if they're selling a product to China, you just want to make sure that's not on the tariff list. So try to stick with stocks a little bit more domestic if they have products, or if it's services, worldwide would be just fine. So a couple I found today that you're just kind of taking a look at here. First one we'll take a look at here is Jazz, J-A-Z-Z. Now, the stock market's been pretty negative here lately, and the stock, even though we've had a really bad market over the last couple of weeks, the stock is still just kind of moving sideways. Nothing fantastic, nothing really out of the wild here, but the stock currently is moving a little bit more sideways. Quarter 4 2018 was terrible, but your charts show a 30% gain. It's a 30% gain versus quarter 4 2017 is correct, Jeff, versus quarter 4 2017, not just year over year, but quarter 4 2017, it was up over the previous quarter from the same year ago, not quarter by quarter, but from quarter 4 2017. So now, if we take a look at this, the stock's kind of moving a little bit sideways through here, but my stock, even though we had a really negative marketplace, it didn't really pull back too much, and it's pretty much held its ground moving sideways. Not a barn burner, nothing fantastic on the stock here, but I like the stock because as bad as the market's been just recently, this one isn't really pulling back like the overall marketplace is. So I like the stock. I'm not expecting any major items with it, but if the stock market does continue to sell off a little bit, this one looks like it should hold up okay. Fundamentally, it's a good quality stock. The way it's evaluated here, it's got a PE ratio. Let me see if I can't make this a little bit bigger for us because I didn't add my PE ratio. You can see if we come through here at 10.61%. For those of you who know how to evaluate a company, what you're after through here, it's got a PE ratio that's lower than its entire industry and the sector and the S&P 500. In other words, it's a little bit undervalued stock compared to its industry, which is the neighborhood that the stock trades in, its sector and the S&P 500. So I like that. It has lots of cash in the bank. Current ratio is over 3, which means it has about a 3-year reserve of cash to be able to go out and pay its bills, even if it doesn't have any more sales, and it has a huge net profit margin. In other words, 24 cents of every dollar of sales it brings in is cash. That's huge, 24 cents. If you look at the biggest 500 stocks in the S&P 500, they only make 11 cents per share. So every dollar of sales, they make 11 cents. This company makes 24 cents. That's a huge amount of profit here, how much money they actually make per share. 24 cents per share on every dollar of sales comes out to an actual profit. So Jazz, J-A-Z-Z. It also has a fair value. If you want to analyze the stock with what's called the fair value, the Warren Buffett target price here, it's got a fair value of $181, also known as the discount cash flow valuation method. The stock should be worth $181, and it's currently trading at about $142. Look at it this way here. If you could buy a stock at or below that price, you got a really good deal. and the stock is already below that price, is at 142. So I like Jazz. Nothing special. I'm not looking at just huge rallies, but if the stock market does poorly, the stock should hold up fairly well for us. Two more here, and then I'll answer any questions you might have as we kind of end this up here. MTZ. So MTZ, another good stock. This one here just recently broke out to the upside. They just reported earnings. Stocks report their earnings, their profits every 3 months. This one just reported earnings, had a huge rally to the upside on earnings. Now remember, what did the stock market do the last 4 days? Pretty negative, and this has gone just the complete opposite. Now, I wouldn't buy today. It just had a huge rally. I'd wait for a little bit of a pullback. And if this stock can pull back anywhere and stay above right here, about $54 per share. So if it can stay anywhere above right here and stay above 54 right in through here. So as it comes back, maybe pulls back a little bit and starts to bounce, be a nice entrance into the stock. And you can see the stock has had huge volume when it popped up there to the upside for us. Another good looking stock is MTZ. I like that, but only once it pulls back a little bit. And the last one here is a DHI. And can anybody tell me why I might actually be looking at DHI, which is, if we take a look at this, DR Horton, which is a home builder in the US. What's the reason that DHI here had a nice pop up here just about a week ago, recently pulled back just a little bit, but still, if we look at the overall trend here for just, so come back to here, what's the overall trend now for just the last 6 months? Nice uptrend for 6 months. But why do we think we might be looking at DHI, Dr. Horton? Anybody? Are they a domestic company, or do they build a lot of homes in China? Okay, everybody's afraid to type that up. A little more domestic. Okay, we'll go a little more domestic. And what did the Fed just recently do? Lower the interest rates, which now makes homes a little bit better buy for individuals. So if some investors are starting to sell some companies, stocks that have products sold to China, well, they got to put their money someplace. Let's put it in a domestic company. It's also going to be a better deal now because interest rates just dropped. So you're going to see a lot of the home builders should start to do fairly well off that information as well. So a little bit rate. So Walter, good. Lower rates are correct. So good information. JAZ, MTZ, DHI, 3 stocks that look okay. I'm not expecting anything major from any of them other than maybe MTZ once it pulls back. But maybe, you know, as we get in through some turbulent times here until things start to settle down. And don't, by the way, don't think because we bounced today in the stock market that little drop we just had is over with. We'll probably drop again before it flattens out and starts to rally. Don't have to, but we probably will. All right. So as we kind of get through that one here, let me answer any questions you might have here. Anybody have any questions you might have about what I just covered here? So what we said is, if I'm going to invest, we have four ways to make money: our job, real estate, stock market, and own your own business. Since we're going to focus on stock market, you think, how big is stock market? Think about everybody who wants to buy a house still needs to get a loan and get their money from where? The financial markets. The financial markets are so much bigger than real estate. So why don't we if we want to make some money, just go where the money's at and learn to do what they do. Learn to buy a stock pre-IPO and hold on to it, smaller company, until it starts to get bigger. We just need to learn how to evaluate some of that. Or once they were already made out there, look for good quality companies that are actually growing their profits and growing their sales. Because if a stock is growing profits and growing sales, the 3 I just gave you are all 3 doing that. If you're growing profits and growing sales, in other words, you have a job and you get a raise every year. At the end of the year, you're growing the amount of money in your bank account. It just gets bigger and bigger and bigger every year. Where should that stock eventually go longer term? And that's really what we're trying to get into here as an investor, not a trader looking for cash flow, but as an investor long term. It's what I want. I don't care what anybody else tells me I need to buy. Those are the rules I have to go back and follow so that I know I'm in good quality companies. Where do we find the pre-IPO information? Good. A nice way to do that here is just do a quick Google search. There's about 15 really good websites for pre-IPO, for crowdsource funding type of pre-IPOs. Just do pre-IPO stocks on a Google search. Hopefully Kendall will give me some more time to come through that. I'd like to do another webinar on just how to find the good pre-IPOs and what to look for and how to buy those for $50, $100, $200, just smaller investments you can just buy and hold. Not penny stocks. These are real companies with real profits type of items through here. But just Tricia, right now, just do a quick web search, pre-IPO stocks. Some more questions for you? Would you recommend the same approach, 4 types post-retirement? I would do with the post-retirement here. Great question for you, Alvin. If it was for me post-retirement, I'd still look for good quality stocks, because one of the things I don't want to happen when I'm retired, as we all get closer to retirement, we all think about this. I'm 56 now. As we get closer, I don't want my principal amount to ever drop. But once I have that principal amount in my retirement account, Alvin, I'm gonna start looking for more cash flow. I'm gonna learn how to collect my dividends off of those stocks, and I'm gonna write some covered calls off of those stocks. And that way, I'm only taking profits from my dividends and covered calls on a monthly basis. Dividends quarterly, obviously, but covered calls monthly, but I'm never touching the principal. They're in good quality growth stocks, which means that the sales and earnings are growing quarter over quarter, year over year, consistently. So I'm just into those good growth stocks. I wouldn't do any pre-IPO stocks in retirement, Alvin, only because there's still that risk level because they're not proven stocks just yet. If you did use that, so for instance, that's a good question though, Alvin. I would take whatever money I might have made by writing a covered call on some of my good growth stocks, and that's risk money now. I can put that into some pre-IPO stocks because I don't need that, and I can let it sit there for a while and just see where it goes to, and then maybe I get 800 or 900, maybe 1,000% on that by the time it finally makes it to the public markets out there. Are you successful at covered calls with which companies? I do like to trade covered calls quite a bit, one of my favorite strategies, and I prefer to actually write covered calls on exchange traded funds, ETFs, fantastic strategy. But you don't write them 12 months out of the year. You might only write them 6, 7, maybe if you're lucky, 8 months out of the year. So if something's in a really, really strong uptrend, you don't write a covered call. You wait for resistance, start to pull back a little bit. Maybe your indicators, stochastics, MACDs, what you look at might start to roll over a little bit. Now you write a covered call above that so you continue to hold the stock, and you buy the covered call back as it drops. Some of you understand that, some of you don't. Those are strategies that I will be teaching at some of the upcoming events in Dallas at our summit that we have for those. So those summit events, by the way, for those of you who don't know when they're at, are September 12th through the 14th in Dallas. Those are our summits that we're going to be at. I'll be happy to talk more about how to write covered calls and cash flow strategies for Kendall here. I know it's only supposed to be about an hour long. If you'd like to stop the presentation, I'll hang on to the webinar part and answer any more questions you want. I just don't know how long, Kendall, you want me going on through here, but I'd be happy to answer more of those questions for you. For anybody hanging on to this, I don't know if, Kendall, you need to wrap up. Otherwise, I'll just keep going.
Hey, Mike, this is Don. No, we're fine on time. Let's
okay.
go for another 15, 20 minutes, and I think everyone, we usually go for about an hour and a half, and a little shorter of that seems to make everybody happy. But no, you're getting great questions, and the Dallas event, you're right, is September 12th through the 14th.
Yeah,
and
it's going to be a great event. Yeah,
right. And the Vegas event is November 11th through the 13th.
Yep, and I'll be there personally at both of those events. So if you guys want to sit down and talk with me, I'd be happy to sit down and talk with you one-on-one and go over any questions you might have as well. So these are great events for me. I love to talk about the stock markets, what I've been doing for decades. It's just like if you do something that you really enjoy to do and someone wants to talk to you about it, it's just something you'll just go on forever. So if you're at the event and want to come back and talk to me at the Dallas event coming up or the next event after that, I'd be happy to sit down and talk with you one-on-one. But the next one I'll be at here, aside from our cruise, for those of you on the cruise, you have me for a whole week. Nothing else to do. Otherwise, September 12th, 13th, and 14th. And you get a hold of me through Protect Wealth as well. Those of you who want to look at Boeing across here, obviously what's happened with Boeing, and you know that they've got some problems with airplanes coming through here, but they also have some exposure over with China as well. And so until their 737 MAX gets figured out, obviously you're going to see the stock continue to kind of plummet down through here. And even when it does get worked out, they're still going to have some exposure to some countries that aren't going to want to take some of the planes now and maybe go a little bit more with the competitors strictly because of some of the tariffs that are coming across. Whether they get involved more with tariffs or how that's going to work out is still unsure. So until investors, the big investors, are sure how Boeing's going to play out with all the different tariffs and the 737 MAX, it's going to be in a little bit of a free fall to the downside. So I like the company. Both of my parents worked at Boeing. They retired from Boeing. I think it's a great company, but it's just maybe not the correct time to own it right now. And if it was me, and if I had some stocks on it and I didn't want to sell the stocks, I would definitely be writing covered calls on these because no one's going to want to buy your stock as it drops to the downside. So you're just collecting some cash flow while it drops because you're still going to hang on to it. And if it's something you might want to sell and wait for it to drop, and then once it does finish dropping, kind of bottoms out, and you finally get some good news on Boeing, now go back and buy Boeing at a lower price and buy a few more shares than you previously had. Now you don't have to wait for it to go up as high because you got more shares before you're finally back into a break-even position. But that's what I look at for Boeing. I like the stock. Might be just a little bit too, maybe not what I want to own at the current moment, but I do like the company. You got to think Boeing's never going out of business. Is it possible to get the recording on the webinar? Yep, you'll be able to get that from protectwealth.com, and I'm sure they'll probably send you an email. Kendall or Don will send you an email on that as well.
So everyone who attended the webinar tonight, you should get an email from us. In fact, anybody who registered, whether they attended or not, should get an email. It usually takes 24 hours for that recording to be available. It will be available for about a week or two, and then it will go into the archive where it's a paid subscription, $129 a year to have access to all the webinars we've ever taught. And Mike's taught quite a few of us for us over the years.
Yes, sir. Great,
Yep.
Great company to work with, Tom. Thank you. Okay, so your question here was on Allo. Obviously, the first thing you look at every time you look at a stock, you just say, what's the current direction that it's moving? And the stock's just in a sideways trend. This is a 6-month chart. 6 months ago, way over here. Current price way over here. It's pretty much the same price it was 6 months ago. Have you just bought and held the stock? So nothing negative or positive about that. The stock market's about the same price it was, a few months ago, so you're not really making too much money in the overall stock market at the moment either. What's more important to me, though, is that the stock isn't profitable just yet. You see the stock has a PE ratio that says NA, and NA just simply means it's not making any money. So price divided by earnings. What's the current price you're paying for the stock divided by what are the earnings the stock actually makes? So you're buying a stock that's going sideways, doesn't make any money whatsoever. I'm not saying it's a bad company, but if I'm going to own a company, I want to buy into a company that actually makes money. If someone says, Mike, I've got a great pizza restaurant, would you like to buy into this pizza restaurant at a set price? Yeah. How much money did you make last year? Oh, we didn't make any money last year at all. Well, I might think twice about buying into that pizza restaurant. Doesn't mean I won't, but I'm going to think twice about buying into it if I could buy a different pizza restaurant right next door that actually, for the same price, actually is making a profit. It's kind of how I look at Allo. So you see right here, it has no PE ratio because it doesn't have any profits whatsoever, 0 profits. So I'd probably not be in a hurry to buy a sideways stock that doesn't make any money just yet. But technically, it's just if you had the stock and it's not really dropping, and you had the stock, you could probably just hang on to it, see if it does start to come up. But it probably wouldn't be my first choice at the moment. But if I had the stock that's not losing any money, I'm not in a hurry to sell it either. I just might not go into it today as a new investment today. Beyond Meat. So Beyond, okay. It's in the news right now. So we're talking about, the pre-IPO stuff. What's the buzz about that? What's it going on social media? Well, Beyond Meats is one of those things that are kind of going on social media right now. So for the people who see the potential with it, you can see when it first went public here as a new IPO. So some people bought it way pre-IPO back here, went all the way back up, went public over here at about $50 a share, ran up to $225, and now it's selling off. I got to think it's going to pull back quite a bit more before it ever stops dropping. And the reason for that is, and I don't want to say anything negative, I love the concept of Beyond Meat, I do. But when you go back and take a look at some of the actual ingredients into this, 30% return, betting against Beyond Meat. So 36% of the people who are trading the stock actually think it's going to drop in value, and they're trading it to the downside right now because it's so overvalued. This stock has an analyst target price of $143, which means what the analysts think the stock should be trading at. And the stock right now is around 161, but it was up around 225 here just about a week ago. I love the concept with it, and I think it's going to get better, and more competition is going to come out here. And this is one of the first to market, which is why you want to do those pre-IPO type of stocks. But now that it's public, had I owned it, I would be selling it, because you might have been able to buy the stock pre-IPO, venture capitalists around 1, 2, 3, 4, 5, maybe 10, 12, 13, $15 a share, and then it went up to 225. What would you be thinking about doing? Now that you had like a 15% or 15-fold increase, 15 times increase, I'd be thinking about selling the stock, only because it's way too expensive for what it's really worth. If you look at the market cap, what the stock is actually worth compared to what their sales are at this early stage, it's way advanced where it should be. So if you can pick up the stock and it pulls anywhere back around where it first went public, around here, and it comes back to about $75 right in through here, if it stops dropping there, I'd love to own the stock at that price, but I just wouldn't jump into it today anywhere near where it's at right now. It just went way too far, too fast. The concept is phenomenal, because eventually we're going to probably want to start going more plant-based versus animal-based, for whatever reason it might be, and everybody's got different reasons for that. I love the concept. I don't like the stock at its current level, at its current price. It needs to make more money and be cheaper in line, so that it's in line with other companies that do the exact same thing. And when that happens, I'd be more apt to buy the stock because the concept is really cool. But right now, it'd be like saying there's a house in your neighborhood for $300,000, but the house right next to yours is worth $1.9 million. That's what they're trying to sell it for, but it's built by the same builder in the same neighborhood on the same size lot in the same area as a $300,000 house right next to it, and they're asking $1.9 million for your house. And so what are you thinking? Would you buy the $300,000 house or would you buy the $1.9 million house? I'd go back and buy the other stocks instead. And so when this stock comes back in line, I would be in a hurry to buy it just because the concept is pretty cool and they're first to market. Everybody's going to want to own the first to market, which is why it ran up so quickly through here. So anytime the stock can pull back anywhere near the $75 level, I'd love to jump back into the stock, but I won't chase it at these high prices. So it's just way too much. Google and Amazon, both just two big names through here. Obviously, neither one of these are ever going to really go bankrupt on us. I like the stock. And these are services that remember we talked about. You don't have a product that you sell outside of the US, but you have a service you sell outside of, that'll still be fine globally. So any stock that has any business in China, but it has a service in China is better off than a stock that has a product that could be taxed with a tariff, which means it might not sell over through there. But both these are going to be okay. Google here pulling back just a little bit through here. I like both of these stocks, Amazon and Google both. I love the fact that they're both just a little bit cheaper now than they originally were, especially with Amazon, was previous price here trading right up around $2,000 just recently, way too high, but now that's worth $1,750. I like it back in this range here. So I like both of these stocks. I think they're both great stocks to own in your portfolio if you just had a couple of them, because these would be ones that, you're talking about, maybe I'm getting close to retirement. If I had a few stocks that I know are never going to go bankrupt on me, these would be two that I would say they're probably never going to go bankrupt on me, that I'd want to own, maybe along with Apple, that are going to say they're still going to be there 10 years from now, 15 years from now, and they're probably never going to go bankrupt. And I'll always have a good quality stock I can use as my cornerstone of my portfolio to do other things with. Because if I know I've got some good safe investments, I'm okay with. That's kind of how I look at through those. Which broker site can we buy pre-IPO? And again, go back out and just do a quick Google search and say pre-IPO companies, and you'll find about 10 different websites that come up that allow you to buy different stocks that are in the pipe or crowdfunding stages, which means the very, very, very early stages. The one I've been working with just recently here is called ISM Club, and I like it quite a bit. But there's a lot of really good ones out there. And just do your research. And so hopefully I'll do another class here with Don and Kendall here with Protect Wealth, and I'll just cover just strictly how to buy pre-IPO, what are the ways to evaluate those companies, and what would you actually be looking for if you were going to buy those, and how long would you hang on to them, and how and when can you sell them later on. So I'll hopefully I can get into one of those. Okay, so those are kind of stocks you're after here. Maybe one last item or one last question you might have. Soli, you had Soli over through here, S-O-L-Y. Clinical trials, got skin in the game, IPO shares some time ago, IPO 3 months ago, dermatology, proof of concept, okay. Clinical trials here, clear dermatology, sanitary hospital, cellulite, solutions, RBS. Okay, so it looks like they got a little bit of buzz coming through here. Stock is just kind of moving sideways, obviously not making any money or anything just yet at all, just zero because they're all brand new. So you're buying a stock that just became public, had a nice pullback coming back down to about $12 a share, about half the price, about double the price it was when it went public. I don't see anything. You can see the volume is really, really, really dropped off coming down through here recently, which means that interest is kind of dying into the stock here until they come out with probably another really good news story. But interest in the stock is kind of dying. You're probably going to see it drop just a little bit more through here. So if you own the stock and you think it's got some really good fundamentals to it, I mean, some really good concepts in the future, it's to be a stock you just buy and hold as you wait for the future. Obviously, the stock that's not making any money at all right now, zero money at all, zero profit, you're buying into future expectations. So this means you use risk capital only, which means money you don't mind losing in case the FDA trials don't go positive, or maybe somebody finally dies because they tried the product, or it doesn't work that much better than everybody thought it was going to work, or better than the competition is actually working when the FDA trials are over with. So you use risk capital with that one. It looks to me like it's probably going to pull back a little bit more before it finally stops dropping. Only because volume is really, really dropping off right now. If there's no buying going on, it'll eventually start to pull back, because people who bought pre-IPO stock are able to sell their stock now, and if they think it's going to keep on dropping now through here, they'll start to sell their stock pretty soon because they're out of their lockup stages. So I think it's probably going to pull back a little more unless it has some more good news, Obviously, it's a buy and hold type of thing, but again, you bought a stock pre-IPO or right at the IPO. You've already made a profit. If I already made a profit, I'm up 100%. If I bought around the $6 level, it's at 12 now. I might be saying, hey, I made 100%, and I'm going to go ahead and sell now and wait for it to stop dropping or some more positive news, and then maybe get back in. Unless you've got some type of positive connection with the company, then you can hang on to it because you know something nobody else knows. That's an option as well. All right, my question, you seem positive on the market term for 2019 and 20. My question is, do you see a recession coming for the third quarter 3 yield is very interesting. Do you see us having a recession coming? It could. I mean, recession could be coming. Again, everything is subject to whatever the news is coming out at any particular point in time. And it doesn't, at the current information I see, no, I don't see a recession coming. Only because as of today's closing day, we do expect the stock market to be higher at the end of this year and higher at the end of next year than this year, based on every single analyst in the country, every single analyst at Goldman Sachs, all the analysts at Merrill Lynch, all the analysts at JP Morgan, all the analysts across the nation here that are looking at the biggest 500 companies in North America are still expecting growth this year and next year. If we're having growth, it's hard to say we're having a recession if we keep having growth. Now that number could change in a week. It could change in 2 weeks as analysts start to say, hey, based on the information we have coming in today, we're gonna start to revise our estimates, and estimates can be revised every single day. But as of today, I don't see it coming. I do see that I think President Trump will come back out and push on the Fed a little bit more, bully them up a little bit, whatever you wanna say. They might drop interest rates again. If they think that's going to happen to help the U.S. domestic companies through here. But at the moment, I don't see a recession just yet. That could change next month. I don't see it as of today. But you're going to hear news about that. You're going to hear all kinds of places because they want you to watch the TV show. They want you to buy more newspapers. They want you to buy more magazines because that's all advertising purposes. So what do you say? You know, I remember watching something a little while ago and someone was talking about you never hear really, really good news on the news because nobody would ever watch it. So they did a positive news story. Today, Billy was playing catch with his dad outside of his house at 3 o'clock. That was the end of the story. Well, that's not news. Who wants to watch that? What you want to watch is, oh, look how bad it is. Oh, look at this over here. Look how bad this is going to be over here. And that makes you want to watch. And so what do? You sensationalize things. And the news is always going to sensationalize to make you watch things. I'm not saying it's not correct, whatever they're saying. What I'm saying is they will sensationalize it to make you want to watch more because they're in the business to sell advertising dollars. They're not in the business to tell you how to actually invest. And so someone says recession, somebody else will say no recession. At the moment, and I'm not saying I'm correct, I'm just saying in my personal portfolio, I'm not currently investing for recession as of today. I'm still expecting some growth. And I think if we start to get more towards recession, I think the Fed will drop interest rates again to protect the US companies, which will spur on the economy. We still have record low unemployment numbers here in the US, which means people are working. Move it forward. If people are working, that means they have money to spend. If they have money to spend, that means they're going to buy goods and services. If they buy goods and services, companies will have to produce those goods and services by hiring more people. Everything still looks good for our US domestic companies. Only negative we really have out there is the economic growth, especially from China and the tariffs out there. Some other European countries aren't doing very well right now, but the domestic companies in the US are doing fairly well right now. So I don't see a recession at the moment. I'm not saying I'm going to be correct. I'm saying in my portfolio, I'm not investing for recession at the moment. It could change next month, but I don't see that as of today. But it's a good question, and it's something that if you're not sure what you're looking at, and maybe you are sure, if you want to invest for recession, just make sure that you still have some positive stocks out there as well, but maybe you just get a little more protective on your positive stocks to invest for recession. Gold and silver, fantastic. I think you're gonna be fine. So I've been in GLD, ticker symbol for gold, Goldilocks, GLD. It's the ETF, ETN actually, exchange traded note that follows the price of gold. Great investment. I think it's going to go up for a while, especially while we have uncertainty with the overseas markets in China. For those of you who are not in gold yet, I think it's going to be gold and silver both are going to be good investments long term. So if you're thinking recession, maybe those are some stocks you might want to still have in your portfolio that will go up whether we have the recession or not. Unless we have just a fantastic stock market, which I don't think is going to happen, gold and silver are going to probably head up between now and the end of the year as well. So I like both of those. Yeah, those are nice ones too. So, okay, good. And then Brexit. I don't know what's going to happen with Brexit. I wish I knew. It's supposed to have already happened. I don't have an answer for that just yet. I really don't. I apologize. Okay, everybody, I really appreciate your time here. Hopefully you got some information. If you can make it out to Dallas and see me out there, I'd love to sit down and talk with you about this as much as you want. anything I can do to help you with your education to make you a better investor so that you don't have to follow anybody else, but you learn to understand the information yourself is really what we're after here. For me, it's a stock market, but with Protect Wealth and Don here, it's about not just the stock market, it's about the rest of your financial education. So Don, I'll turn it back over to you.
Well, Mike, thank you for being here. You had a couple questions about your website. Tell us a little bit about your website, and I assume it's a paid website, but you also sell education. Do you have to have the education to get into the website? How does your website work?
So my company is invest-edu, short for investing education, invest-edu.com, and it's a $25 a month website. We don't have anything for sale on the website. There's no ads on the website. There's no product for sale on the website. It's just $25 a month website. It's really meant for investors who actually understand a little bit about investing, because there's a lot of proprietary tools on there that are just nobody else has. And I kind of showed you a couple of those really quickly. I didn't explain them to you when I was on the website looking at some information. But yeah, we have lots of educational courses. We are the largest stock market education company in North America, privately held company out there. And we do classes, stocks, options, bonds, futures, commodities, currencies. We work a lot with Don here and Kendall at Protect Wealth, great company to work with, just because they really believe in education for their students. But we have lots of classes, and if you're interested in learning about different types of investing, yes, we do have classes. And again, you can email me. My name is Mike at invest-edu.com. I'd be happy to answer, or get a hold of Don and Kendall. They can forward it to me. But access the website if you're interested. There is no sign-up page for the website. I don't have it open for people. You actually have to ask for access to it, only because there's so much information there. I don't want you to get access if you don't understand it. But we'd be happy to, if you're interested in that, $25 a month as well. Just let us know. I'm sure we can help you out with that too.
Mike, you're awesome, and I'm getting really excited. Tonight I'm packing for a cruise. I see Al on. Looks like he'll be there. There's several students I've seen that we're expecting. So until most of you, I know a lot of you have registered for Dallas, so we'll see you there. And if not, then keep watching the webinars. We've got a great series coming up throughout the next few weeks. Keep coming back. We appreciate all of our students. Mike, I especially appreciate you, your time, your expertise, and your patience with us newbies trying to learn this. Thank you for your especially your patience and your time tonight. Thanks, Mike.
You bet. Thanks, everybody.
All right. Have a great night, everyone. Okay. Thanks for being with us. Good night.
All right, bye-bye.